Hello and welcome to our interview series where we bring you valuable insights from top fund managers across leading AMCs. Joining me and my colleague Chirag today is Raunak Onkar. He's fund manager and research head at PPFAS Mutual Fund. Welcome, Raunak.
Hi, thank you, Chirag and Ruchira for having me here.
Good to have you here. Now, just to begin with, a few questions related to your background and your journey so far. If you could explain what sparked your interest in equity investing, was it something you always wanted to do, or did it happen by chance?
It happened completely by chance. So I was in my second year of graduation, doing my bachelor's in IT, and somewhere I got a interest that this is something I would like to study as a curiosity, and did not have any background in finance. My family had no background in stock market investing. They were all salaried FD kind of investors. They had only one asset class, that was FD, which was financial assets, and the real estate where we lived. So beyond that, there was no background of finance in the family. So I had no particular interest to do it from childhood days. But at least during my college, I had some interest as to learning a little bit about what is the stock market, how savings work, some basics. And it was such a mundane story that I happened to read about Warren Buffett in Economic Times. And I think the journalist did not know Warren Buffett that well. So he just mentioned that there is this furniture company owner from the US who is the richest person in the world. So how is it possible a person who sells furniture becomes such a rich person? And when I started reading about the person, which was Warren Buffett, who at the time Berkshire Hathaway owned Nebraska Furniture Mart, and which is why they had picked up that particular business. But it was a conglomerate of businesses. I learned how Buffett started investing. I read his letters, and it's complete happenstance. I had no idea I would be sucked into it. But to get a good grounding of it, I think Buffett kept on mentioning Ben Graham a lot. And that's when I actually read Benjamin Graham's Intelligent Investor, which is probably the most accessible book for somebody who does not have too much background in finance, but they can at least attempt to understand what he's trying to say about the behavioral parts of investing and investing as a long-term oriented activity, or investing not just in a piece of paper, which is a stock, but actually a underlying business. All those concepts were very new and resonated very well with me, because maybe I'm also of that same nature in terms of the values that I have personally. And because of that, I went on that journey. And by the time I reached my final year of bachelor's, it did feel like working in an IT company would be a step down rather than owning an IT company as an investor. So, a stupid idea again. But again, I took a break of 1 year before trying to figure out this is really what I wanted to do. I had a placement offer in my hand, but I did not join, seeking that if I have to make a choice, this is today and not few years later when I started actually working. When my focus will be then divided across one area of work versus investing or learning this as a profession. It was a ridiculously risky thing to do against my family's wishes, but still, it worked out well. It was immensely lucky as well in the entire process to meet the right people, to build a network of friends, and also, of course, getting a chance to work with PPFS.
Raunak, you said 1 year which you took break while means after doing your IT. What was the 1 year which you did? Could you just elaborate more on it?
So mostly it was trying to figure out whether I can do this or not. And
Okay.
that means that, see, in investing, the best part is you don't need to work with somebody else to understand what you're doing, because all the companies are listed. All the financial information that you need about understanding a business or a stock is in the public domain because these are listed companies. All you need to do is understand what framework you want to use. So there are several frameworks. One is a short-term trading oriented framework, which goes on momentum and other factors that people track. And then there is this value investing oriented framework, which has a lot of history of written material, mostly US based investors who have written down through their letters and through books that many professors, academicians have written. So a lot of material is available. That 1 year actually opened my eyes to all this material, and it mostly was spent in reading. all these things and trying to get an understanding of whether it's something I'm capable of doing. So right from going to the basics of so what a person studying in BCom would learn in 3 years of BCom, I had to crunch it in a matter of few months to understand whether I understand accounting, whether it's something I can figure out. When you open a balance sheet, do you know what are the important ratios to understand? And this is a time before we had Screener or other kind of apps available. So you had to, if you really wanted to build a model, you had to rely on building it yourself through the company financials. Now you can click of a button, open up any company, the entire 10-year history is in front of you, and you can analyze them in a matter of seconds. At that time, you had to read through stuff. This was again during the internet, so it really helped in finding a lot of resources very, very easily, very easy to connect with people. And what I really liked about that period is whoever I reached out for understanding or help or assistance, and it can be a senior person in the industry or it can be any person who has written something online, who I just had his email ID and I wrote to that person. These were extremely accessible people, and I could learn a lot from them. And it was very useful. That 1 year was spent in just reflecting whether this is what I want to do, reading a lot about what the theory was before this, and actually trying to have a paper portfolio and saying, okay, let's see if I can do allocation also. I had no money, so of course it had a paper portfolio, but it was interesting to at least try it on in my head before I made a full commitment.
So, Ronak, then another interesting point was during the global financial crisis of 2008. I read somewhere you wrote a blog, and someone from the PPFAS team contacted you, and you were hired as an internship. Can you just, can you walk us through what happened and how that opportunity came about?
So I've been writing a blog at that time for a while. It was not new. In 2008, somebody from PPFS, a friend of mine now, Arpit Ranga, who was working here, he wrote to me about some blog post I wrote, and the blog was nothing to do with investing. It is completely random stuff. It is basically armchair philosophy. Sit and read something, and you put your summary and ideas out there, like how Twitter is used today with short form posts. I was doing with long form posts, and it just got noticed by someone, and we connected over some random idea. And as we grew as friends, we I asked him, where do you work, and is a company I want to do an internship in, do you know somebody there? And he happened to be working in that company. It was just a coincidence for me, and at least I got an interview in the company, and after the interview I cleared the interview and joined as an intern, and it was a game changing experience. So I have no context of working anywhere else before that, so I had no expectation of what to do or what to know when you join a company which is into investing. At that time, PPFS was also a broking business, and they had a PMS running parallelly. And it was interesting to see that within the company, as I entered, it was a learning oriented atmosphere. It was a growth oriented atmosphere. You were encouraged to learn new things, encouraged to read books, encouraged to come up with ideas on your own. There was a wide field of stuff you could do on your own, which some part of the culture we still retain in terms of giving people the leeway to be creative about finding ideas and finding interesting things to study. That kind of growth-oriented mindset really gelled with the way I was thinking at that time. And after the internship, I also got lucky. And I asked Parag Bhai whether it's a good chance that I can get to work here as a full-time employee. And gladly and to my luck, he accepted. And I have been here ever since.
Right. So, like you mentioned, that this was your first job and you've spent your entire career at PPFAS now. So, what are some of the most valuable lessons that you've learned from Parag Parikh himself and Rajeev Thakkar as well?
I think both of them have very strong foundations in what is important for them as investors and even as individuals. So if you see Parag Bhai, Rajiv, if you've heard them speak, if you've read their articles, there is a principle of investing that they follow, which even in our tagline, you can see it's called the one right way. And the one right way does not mean that there is only one right way for everybody else. It is for us. Based on what we know and what we understand, we think there is a right way of investing. There are many other ways to make money, but this is, according to us, a great, sustainable, long-term way to generate wealth over a long period of time. So that was a very good grounding that I had in terms of understanding what really matters in looking at investing, and the grounding that I had built by reading Buffett and Benjamin Graham. That also really helped because that's the same thing that they were doing while trying to find ideas, trying to build a portfolio of good ideas. and investing in the long term. So if you see the portfolio turnover, even during the PMS days, it was very, very low. It is exactly the same investment style that we had in PMS is now replicated in the mutual fund. So from philosophy point of view, it was very useful to see that not much changes over a long period of time. Once you have your principles in place, your principles should not change. Your learning can improve, but your principles should not change. That was a very important lesson I learned very, very early on from both Parag Bhai and Rajeev. And also the attention to detail, trying to study different things, have a curious mindset, have a critical mindset where everything you hear may not be taken at face value, how to analyze different things. Some of these softer things also kept up. So whenever I would make a naive judgment, it was always encouraged for me to think the other side as well without dismissing my judgment completely. Saying, okay, you have this point of view, but what about this side, what about that side? That debate culture that still even exists at PPFS, and the research team definitely benefits from that culture as well. So encouraging someone new to learn, to pick up the ropes, and to carry on the same philosophy. That was a very interesting thing. I thought I would have never expected this is something that happens generally at organizations.
Product PPFS has a reputation of deep research, as you mentioned. How does that focus influence your portfolio construction? And as a fund manager, how much autonomy do you have in making decisions? Because if we look at it, then there are around 4 fund managers who manages the PPS Flexi, the flagship fund. So could you just tell us about more on this thing?
So although we are listed as fund managers, you will see that there are different roles which are assigned to us. So I'm assigned for the overseas part. There are Raj and Rukuna for debt and equity, and Rajiv is the CIO who oversees the entire investment team. The autonomy part is always there. So unlike most other mutual funds where there are multiple schemes and single fund managers run those schemes in many places, in our case, it's the same fund management team that manages all the schemes, all the 6 schemes that we run, except for the liquid fund where I'm not a fund manager there. But over here, if you see, the research is a core part of the process. Without having a good conviction on what company we are studying, so do we really understand what the business of this company is? Do we really understand what the mindset of the promoter is? Is that promoter having a good history in the market in terms of being honest and you would say considerate towards the minority shareholders and not cheating them in the long run? Does the promoter or the management of the company have the competence to run that business and see different cycles over a period of time? And at the same time, also having a keen observation on where the valuation of this business should be, and can we price that company based on what its past trends have been, what its future trends could be, without depending too much on the prediction of what happens. So all this requires a lot of research, and the way we have structured our research team today is, and even right since I've been there, we have a structure in place where each analyst would get a sector to cover, and they would become sector experts in those particular sectors. And once their expertise is built, they would then keep on pitching ideas to the investment team, and we will internally debate how this business works. They will keep on generating insights, and they will keep on pitching the idea. And meanwhile, in the back of our minds, we will develop a valuation framework as to, okay, what can be the right price to pay for a business like this, and whether today is the right price to buy, sell, or hold that particular business. And that really guides us to build that confidence to buy a particular stock in the portfolio, hold it for a long period of time, and also, even if the valuation corrects and we think that the business is doing well, we still have the confidence in our research that, okay, this is something which can be a short-term phenomena, which can turn out to be better in the future. Of course, doesn't always play out, but that's why there's a portfolio. You diversify yourself across various ideas which you think are good and can do well, but we don't know exactly how much. So there is no decimal accurate answer you're getting here, but there's always a range of expectation where you know that this is where it should land over a period of time, and you keep tracking that trajectory with the help of the research team.
Now, how would you describe your personal investment philosophy? With changing markets, has it evolved over the years, or?
So I don't have a personal portfolio. My entire net worth is invested in either the PPFAS mutual fund schemes or the shares that we have got through our ESOPs. So my entire net worth is basically PPFAS investments, and I'm very, very attuned to the same style of thinking of the way Rajiv has been running the funds, and all the other fund managers are also in the same boat. So I think personally, I have not shifted my investment mindset as much. Like I said, the principles have to remain the same. All you have to do is opportunistically make sure that you're invested in the right trends, So the entire focus has been to expand the breadth of knowledge, the circle of competence, like it is said by Warren Buffett. Keep on expanding that, either yourself or with the help of the research team, and make sure that you are participating in all the right trends. So yeah, the principles remain the same, the philosophy remains the same, and I would continue. I don't think there is a reason to change it.
And what's the philosophy and principle of managing the funds? In a brief, you could explain it.
So if you know the basic tenets of value investing, I mean, these sound very simple, but actually it has to be simple. The most important thing is when you're investing in a business, like I said earlier, you have to think in a long-term manner. You can't invest in something as a trade, saying that, okay, I will buy this stock today. If the stock goes up by so much, then I will sell this. You have to basically see that where this business is going, where it is in this cycle, and how that business will evolve over a period of time. So understanding of the business is very, very important, and what that sector is going to do in the future is very, very important. Number two, do you trust the people who are running the company? So, like many people think that most companies run on autopilot. Actually, it's not true. There's a lot of complex stuff that happens in the business. One is, of course, strategy. Second is execution, and third is managing the on-ground operations in a very cost-efficient manner. And also, if you are in a country like India, there's a lot of extra things that we are also seeing in the regulatory evolution that happens in the country, where in most developed countries, it's far more stable in many cases. So all those things have to be managed, and yet you have to have a competitive product, competitive pricing, keep generating profits over a long period of time, and reinvest those profits in new areas or existing business to scale your operations or diversify your operations. All those things need to be handled. So you need competent people, you need trustworthy people who will not mismanage your money. Basically, the money that the company has is in the hands of the few promoters who are the majority shareholders of the company. And there are good promoters and bad promoters. Some promoters will use that as a personal ATM, whereas the good promoters have that fiduciary responsibility that, okay, this is not my money, this is the shareholders' money. I'm also a shareholder, but I'm also an operator. So I need to make sure that I'm using this money, allocate this capital in a way where it benefits all the shareholders, including that person themselves. And thirdly, are you paying the right price for that business? And this is where it's tricky, because pricing of any stock or any sector or a company is actually an opinion. There's a range of opinions that are there, and based on those opinions, you have to be at any spectrum of that opinion. So there are companies where you might miss, where the growth might surprise you a lot. And there are companies where you price the growth correctly and buy the stock at the right price, and the stock does exactly what it's supposed to do. That's a great outcome. And sometimes where you overestimate the growth and you overpay for that price today, for that business today, and your outcome is not going to be as good in the future. So once you know this range of outcome for any business or a sector, then you know that this is a good price to pay for this business, to buy this business today, or this is a good range of price to hold this business, or this is a range where you should start selling or start thinking of liquidating that position. So these are three areas where you focus on. One is the quality of business, the quality of people running that business, and what price you pay for that business.
Ronak, coming to specific to the Flexicap Fund, despite expanding of 63 stocks in the portfolio, the top 15 still makes around 60% of the overall portfolio of the assets. So, sorry, suggesting the concentration remains largely intact. Would you say that the fund's core strategy has remained unchanged despite the number of stocks increasing?
I would like to make a correction here. When you say 63 stocks, you are also counting the arbitrage positions that are there, which are not part of the core portfolio. They are basically held in lieu of cash. So if you see, there's 20% cash that we have in the portfolio, and some portion of that is invested in a cash to future arbitrage, where you buy the stock in the cash market and sell it or short sell it in the futures market. So it's a hedge position. And basically, you get a yield on that transaction, which is equivalent to your money market return that you get. So when you count 63, that is basically including the arbitrage stocks as well, which are not part of the core portfolio. The core portfolio has around 30 stocks. And yes, you're right, the concentration remains the same. So it's not a largely diversified portfolio. At the same time, we want to retain concentration in the companies we have high confidence in that they will do well. And we will try to maintain higher allocations in those companies.
Right now, both the Flexicap and ELSS funds at PPFAS, they have shown a willingness to hold cash when valuation seems stretched. So, with the recent market corrections, do you see compelling opportunities to deploy this cash? And if so, which areas look most attractive to you?
So there are not too many compelling opportunities. So one thing is, although the market crash has happened and some stocks have indeed fallen, but they were also bid up quite severely just before the crash. So although they have come off from their peaks, they are still not very reasonably priced to build a new position in the portfolio. But nevertheless, we are finding opportunities in areas where we already have some exposure, which is the private sector banks that we have. That is the most attractive category of investments that we have at the moment, and we have been adding to those stocks whatever cash we have been getting, whatever inflows we have been getting. But broadly, the cash position in the fund still remains very high, close to 20%.
Raunak, just wanted to understand your view. Considering the scale of the Parag Parikh Flexicap Fund, would be the ELSS fund with a similar philosophy, since the international equity, be better choice for the long-term investors, or do you still believe that the Flexicaps can sustain its performance despite its size?
So performance again is dependent on a couple of things. One thing is the stocks that we pick and how they behave over a period of time. And secondly, the diversification that you have. So, for example, the FlexiCap fund, like you correctly said, has the international exposure, and the tax saver fund does not have the global exposure. But that global exposure of FlexiCap is also now reduced because of the RBI restrictions, where we are unable to deploy, the entire industry is unable to deploy fresh capital to overseas stocks. So, which has now come down to about 12%, which is still sizable, but it is still not what we would like it to be, about a third of the portfolio. So both of these factors matter. And if you see the portfolios of both TaxSaver and the FlexiCap, they are broadly overlapping. The only thing where they don't overlap is the global exposure, where we have Amazon, Microsoft, Meta, and Alphabet. The replacement of that is very hard to find in India. So we bought some of the local IT services companies in the lieu of that. But again, it's not directly comparable, but it's something similar in terms of cash flow generation, consistency of cash flows, nothing to do about growth. So growths are completely different for both these companies. And if you see, there are some other smaller companies which are not part of the FlexiCap fund because the market caps are far smaller for us to make a meaningful allocation in the FlexiCap fund. That's the only difference. Apart from that, if you see most of the stocks, the top 10 specifically are broadly the same and which have driven the returns. And in fact, if you see over a period of time, the tax saver fund has its own independent track record of returns. And investors who are more willing to only invest in domestic securities and anyway have a longer term view, they can invest in the tax saver fund. But mind you that there will be a 3-year lock-in like any ELSS fund has, but should not bother investors because they anyway are going in for at least a 5-year term of investment, which we encourage investors to do. And in FlexiCap, again, it's a global plus domestic, which is larger fund, which is fine. But I don't think we have had the issue of not being able to deploy or invest in our ideas that we like, despite the size of the fund.
Moving on to a few stock selection and your valuation approach related questions. So, what are the non-negotiable qualities that a company must have to make it into your portfolio? If you could elaborate on that.
No, so I'll just repeat what I said earlier, but I'll elaborate that point now. When I said first thing is the quality of business, and what does it mean to have a quality of business? Is that over a period of time, the business is able to generate more return on capital than the capital they have put in, and the cost of capital they put in. So if the company is borrowing money at say 10% interest, just a random number, they should be making consistently more than 10% in order to justify the investment and also the other expenses that they have to pay apart from the interest that they will bear on the money that they have borrowed. So the business should generate a consistently high return on capital, which should be above its cost of capital over a long period of time. And that's the reason we have a slight bias towards companies who have a longer operating history. And we might take a little while to understand newly listed companies because they will not have that same track record of operations. So yeah, a longer track record of return on capital, which again is a factor of how well the company is managed, how much they are able to price their products better as compared to the competition, how they manage their costs, how they manage their growth expectations and the increase in costs, how they manage taxation. Some of these things are maybe similar in the sector, but individually companies can vary quite a lot based on the management style and the way they think and how aggressive or how conservative the management is actually running that business. So the quality of business comes from that, a simple thing like return on capital, which should be higher than the cost of capital over a long period of time. And across various cycles, the company has demonstrated that they can, no, you basically know the peaks and the bottoms of the return on capital that the company can generate. And that gives you some comfort. Okay, this company will not change over a period of time. Little bit they will change as the industry evolves, but should not evolve so much that it's unrecognizable to you in the longer run. So that is one non-negotiable area where company should generate a return on capital which is respectable over many cycles. And this actually also helps you to filter out other companies which you are tracking. So it's not necessary that you will only have one company in radar. There is 4,000 plus listed companies, and you will have many companies in your radar. So this actually becomes a good filter to see which other companies of similar characteristics of return on capital are also around, and which might provide you a better way to build a portfolio with. So one thing is the ROC part, which again, I'm slightly oversimplifying, but that's where the bulk of the research goes, that whether this company has the competitive dynamics to manage this return on capital over a period of time, whether the management has enough depth that if something happens to top person, whether other people are going to run this company well or not, whether the promoters have the mindset of making sure that the business has a chance to scale or not, whether they are limited in their way of thinking and just want to do only one thing. So all these things matter a lot, which distill in the longer term trend of the return on capital that the company generates. Secondly, like I said, non-negotiable quality is the quality of promoter, where we go through all the past history, dealings, the business operations, personal information wherever we can find about the promoters and manager of the company, and we build our view about how they are as people and how they are running this company. So one part is of course the competence, that being an expert and professional in that sector, how they run those companies. Secondly, in terms of how they behave as shareholder trustees with the fiduciaries that they manage the business. How do they allocate capital? What are their views about capital allocation? How they have evolved over a period of time? Are they more prone to borrowing money and doing crazy investments, or are they very, very sensible about debt and they know how to manage the balance sheet of the company very well? Are they very, very careful about cash flow generation, cash flow management, paying out money to shareholders on time, either through buybacks or dividends? Are they savvy enough to understand the cycles of their own stock price movement as well, to take advantage if they want to do buybacks over a period of time? Do they use their stock as a currency to buy businesses, or do they wait for the right moment and use cash and other debt to buy any other acquisitions that they do? Are they is their mindset dependent on acquisition, or do they have an organic plan to grow their business? So all these things matter in terms of how the quality of the people that are running the company. And over a period of time, it is revealed. So it's not something where you have to dig specifically. You have to just observe what the company's management has done over a period of time, what the business has done over a period of time. You have to also try and separate, are they skilled at doing what they are doing, or are they just lucky and the cycle was in their favor and they just happened to be at the right place at the right time, which is also fine. If you are riding with them, it's perfectly fine to be lucky along with the promoters and the managers. But this is one thing is very non-negotiable, is the quality of people, and they should not have a past where you feel like, okay, they might steal from you again. So if a person steals from you once, they will definitely steal from you again. So it's better you don't try and go with a promoter, even if the price of the stock is very, very attractive. The person's nature cannot change. So it's better you stay away from such people. And a lot of examples are there in the market where corporate governance plays a very, very important role in the long run operation of the company and the sector as well. And third, non-negotiable is the price that we pay for it. And that is the only things which can control actually. So the reason why these three things come up is these are the controllable things for us as investors, that when we know these three things exist, we can actually know exactly where we can draw the line for all these things. And that line can be different for different people. So it doesn't mean that what we say is the ultimate truth and this is how you should invest in the particular company that we track. But we draw a line at quality of business, quality of management, and the price we want to pay. And these become the non-negotiables for us. And within the team also, we debate about the pricing far more once we are convinced about the people and the business than we debate about the quality of the business itself.
Raunak, how do you identify the emerging leaders? Are there any specific qualitative or the quantitative signals you look for?
So emerging leaders, I think, become only obvious in hindsight once they have emerged and become larger. So in the beginning, I think the characteristics I mentioned, that it can be a smaller company also, which demonstrates all these characteristics. Like Asian Paints 25 years back was a small company, right? I mean, it's not necessary that the company has to be a large company to begin with. It could be a small business run by competent people and they have the mindset of scaling and growing that business. And there will be many such people who are doing that. It's not necessarily that this is the only company who has the monopoly of that idea, but many companies will be doing that, and you should be able to identify those and build a portfolio with those. So, for example, if you see, we have four large private sector banks in the portfolio right now. It's 20% of the assets under management. Now, do we really think banking is such a different business that these four companies have the monopoly to run a banking operation and the other fee-based income business that they have? Absolutely not. There are several people that can come in, but there are inherent competitive advantages and scale advantages and distribution advantages that these companies have accrued over a period of time, which definitely will help them in the longer run to maintain the sustainable return on capital of that business and also grow along with the growth in the economy. So this is why we chose these companies versus any other private sector bank which could have bought, which are much smaller or also have different dynamics or regional dynamics to them. Which is again a diversified business choice that we made. So it's not necessary that we can pick an emerging company in the early stages. But of course, over a period of time, we keep tracking how the company evolves, how the business evolves, how their segments are evolving. So, for example, when we first bought the foreign stocks in the portfolio, we were ridiculed that, oh, why are you investing in global stocks? India is the growth market. But actually, what we saw is there are companies outside of India which are doing things which nobody in the country is doing in the listed space. So, for example, we all use Google search, we use Android devices, Apple iPhones. We are actually using technology right now which is owned by a foreign company. So most of the things we are just users and merely observers of how these companies are becoming bigger and bigger every day. And the idea was, can we participate in them? And fortunately, a product could be created like the Flexicap Fund, which could participate, and investors in India could invest in rupees and invest in these companies directly through the fund. So again, these are, you can call them to be emerging sectors and emerging trends. For example, we didn't know when we invested in Google that they would start a autonomous car driving company called Waymo, which will compete with Uber and everyone else in the world. We didn't know they will buy YouTube. We didn't know Facebook will buy WhatsApp. So all these things happen to become emerging things in hindsight, but you just follow the principles of filtering the stocks. And if they meet your principles, then I think you're okay in terms of holding them in the portfolio.
Moving from emerging leaders to industry leaders. So while investors focus on industry leaders, what, according to you, are some common pitfalls or factors that they tend to overlook?
But of course, yeah, there's always going to be, there are 4,000 plus companies listed in India itself. And if you consider global markets is a much larger number, I think the biggest pitfall is, see, any larger company, first of all, has the resources to scale. Okay, one should not underestimate that. They will have resources to scale. They will have the distribution reach. They will have the capacity to experiment. So if those companies are not using that advantage to do R&D and experiment and find newer areas to grow, then yeah, people generally can miss out. Even the larger companies can be duds in the longer period of time. But on the other hand, if you see smaller companies where there is a monoline business, there is a concentration risk of vendors, concentration risk of customers that they serve. Even there, you can find areas where company looks very promising on paper and all the boxes are checked for us. But actually, the business concentration risk will play out when the cycle turns against that particular company. So I think and lack of understanding of cycles and how they affect the company's balance sheet cash flows, that is one thing where investors maybe they are not paying attention to. At least in this market, I don't see people paying attention to those things because everybody is now focused on growth and India being the next big market. And the valuations of even mundane businesses are actually quite expensive. So that is one area where I think people should really understand the cyclical aspect of the sectors or the companies they're investing in. Second is there's a quote that Ben Graham has that obvious prospects of future growth do not necessarily translate into obvious profits for investors. And what he means by that is we might know the sector is going to do very well, but what is the kind of business model the company has, whether the business model is dependent on cyclical benefit or is there a structural change that is happening in the industry, whether the promoters have the capability to reinvest capital to grow themselves and at the same return on capital. All these questions are unanswered in the initial part of these trends that are there. So it's very, very important for investors to focus on competitively positioning that company versus rest of the world, where supply chains are no longer just India focused. There are companies in China, there are companies in Europe, companies in the US, which these companies are going to compete with. So it doesn't matter if you're listed in India. What matters is how we are going to compete with the world. And if you're only dependent on, say, the import duties advantage or tariff advantages that you have because you're operating in India, then that competitive advantage may be fickle and it may not be a strong competitive advantage. So focusing on competitive advantage, quality of people, quality of cyclicality, and structural benefits in that business, some of the things I think people miss, irrespective of the size of the company. They can be a larger business or a smaller business.
As you rightly mentioned, industry leaders often come with the valuation premium. Do you think all the leaders justifies this premium? How do you assess if the premium is fair or it's there a mismatch?
So absolutely, valuations of many companies sometimes they are stretched beyond comfort zones for even holding on to the stocks, and that happens from time to time. So this is not some anomaly of the market. This is the feature of the market. Sometimes people overpay for the opportunity, and over a long period of time, the opportunity doesn't pan out. If it pans out, of course, they make a lot of money, and I told you so happens. But over a period of time, those examples are few and far between. Not all companies who are bid up definitely justify those valuations over a period of time. So again, valuation, there is actually only one right way of doing valuation, that is do a DCF. You project all the cash flows in the future and put a discounting rate and see what the present value of the stock is and compare that to the value of the stock today. And you realize, okay, now there's a gap, there's value. If the gap is against you, then it is expensive. But unfortunately, the world is not so clean cut where all your predictions are going to happen exactly like you put them in the Excel sheet. So you need to have some range of expectations. So one way to look at valuations is the pricing approach, where you price the business basis their past growth. And if the business is going to consistently do what they have been doing with a little bit margin of growth changing up and down, then you can actually price it in a certain band with with itself and with its peers. So then you can know that, okay, pricing with these peers, we can know this company is in the mid range or in the most expensive range or very cheap range. Then once you know that it is in the particular range, you try to investigate by maybe seeing, okay, what has the factors working for this company versus for its peers in that same industry, and why both valuations are different or similar over a period of time, or how they have changed over a period of time. But yeah, apart from doing a DCF, this is probably the closest you can get. And then you can have a range of expectations. So it's not going to be a decimal accurate number, like I said. It is going to be a range of expectations where, okay, within this particular range of price, this is a good, attractive price to buy. In this range is going to be a good, attractive price to hold. And beyond that, it's going to be a territory where you should think of selling or maybe wait for the right price to come if you want to buy it.
Can you please elaborate on your process of valuing a company? What are the factors that you prioritize, and do you have a preferred method there?
So we do prefer pricing of stocks the way I mentioned just now. And what we do is we need to understand as analysts and fund managers what the cash flows of the company is, and can they continue to generate a bare minimum amount of cash flow over a period of time. And those cash flows will basically generate the future returns for us, because the cash flows will be used for reinvestment. They will be used for paying out money to shareholders in the form of dividends or buybacks. So these cash flows really matter. And once we establish that there is a base cash flow that this company can easily generate and sustainably generate, then you know that there is a bottom to the pricing of this particular stock. That when it comes very close to that, you know that it's a very attractive price to buy. And when it deviates too far away from the cash flows that the company makes, then it's too expensive a price to pay for that particular business. So that is one way of looking at things. There are some companies where the cash flows are very, very predictable, and one could actually do a DCF in those companies, but there are not very many companies who can do that, where you know their capacity is constant. Like a utility business, you can actually do a DCF because the capacity is known, their pricing is regulated, their debt profile is known, how much they borrow has been announced well in advance. You can actually look at the papers where they have already borrowed and issued money from the capital markets. You can actually price everything properly and then build a DCF. But those are very few companies where the nature of the business is so cut out and predictable that you can do that. Most of the businesses, I think, pricing is I wouldn't say an accurate way of doing it, but you get a range of expectations when you do pricing.
Raunak, coming to some specific of the markets, markets are in a consolidation phase right now. Do you think the current scenario is expected to continue, and what can be triggers for the potential recovery going forward?
The short answer is I don't know whether the market is really consolidating or what triggers will really have. Because what happens is it is always been uncertain. So we should not delude ourselves that we have some amount of predictability, because we are all reading the same media, we're all reading the same companies' financial statements and transcripts and annual reports. So it's not like everybody else is going to have a materially different insight as to what is going to change. My biggest thing is that any company we look at, do they have some shock absorption capacity if something happens globally? So, for example, take an example of COVID time when nobody knew how severe the COVID crisis will be. So, around December 2019, you started to read news about some virus spreading in China. Who knew it is going to be that big? But 2 months later, everybody was in the phase of lockdown and the markets crashed and everything. At that time, the most important thing was whether the company would survive or not. Nothing to do with the growth expectations of that sector or a business. Most importantly, whether this company will survive. And if the company has enough cash reserves, the company has some shock absorption in terms of taking a hit, in terms of not earning money for a while, or a couple of quarters or 3, 4 quarters, they are not able to do business in a normal steady state and absorb all those costs and still survive at the other end. Those kind of companies are the companies you would want to look at in the longer run as well. So those characteristics were already in place. When we looked at companies with strong balance sheets, strong cash flows, they already had these shock absorption capacity. Companies who did not borrow too much money or did not were not over levered, they actually benefited because they did not have to meet their interest rate commitments during that period of time. Companies who had a good HR policy, they did not fire summarily people and still managed to retain bulk of the talent as the post lockdown opening up the growth phase came. They had people on their payrolls to take advantage of that. Of course, there are some companies which disproportionately benefited, which catered to the digital ecosystem, where shopping online or communicating online or softwares, all these things, they benefited disproportionately because most people had to depend on these tools to get their life back in order while working from home or doing anything from home. So, of course, you need to balance yourself in terms of understanding where the opportunity can be, but not necessarily. We will never know in advance what can hit you. So it's always better to have some margin of safety in the companies you look at, and the companies themselves should have some capacity to absorb shocks. And then the peaks will take care of themselves, but the bottoms will be much less severe.
During the current market correction, which sectors or companies have started looking attractive to you? You did mention private banks there, but are there any other? And are there any other that still seem overvalued?
Most of them are in the country are overvalued. So if you see consumer brands, if you see retail stocks, most of these businesses which have consistent cash flows seem to be very overvalued. Or I mean, compared to the opportunity size that we have in our country and the growth that they have seen, the growth has not changed that dramatically if you see over a period of time. So yet the valuations have not come down to a level where they can even be compared to some of the global peers who are in the similar business categories. That is one area where we think uh, in India, at least, we don't have that much of a comfort to buy any new businesses. But interestingly, global markets are actually doing very well in terms of the cash generation and profit generation of companies in various global sectors. So you can have these tech businesses globally, which are now reasonably valued. There are many companies in the innovator pharma space which are very interesting globally. So I think global markets do have some kind of a valuation edge at this point in time. But India, I think it's better to stay cautious rather than just chase that illusory growth that everybody is looking at. See, growth will come over a period of time, and we have seen that happen over the past several decades after the liberalization happened in this country. But that does not mean that you have to keep paying for 20 years of growth today. You can gradually grow and then see cycles over a period of time and then participate when the valuations are right. I think we are in that camp where we would rather wait and find a right valuation than to deploy our entire portfolio.
And lastly, Ron, before we wrap up this chat, even with the good stock picks, many investors falter due to the poor portfolio allocation. What basic rules would you suggest them for the beginners to get the allocation right?
I think the allocation is the hardest part because just like valuation, there's a lot of individual subjective understanding of how much risk you can take. So there are people like Charlie Munger, who all the value investors revere for his insights on various things. He was famously saying that you concentrate your portfolio, don't have too many stocks. Whereas on the other hand, you will have very successful investors who have a reasonable diversified portfolio of 25, 30 stocks and did very well. People on the other extreme, like Peter Lynch, had thousands of stocks in their portfolio and still had a long track record in the US market at that time for 15 years. So again, there is a range of learnings over here where each individual will have to understand what risk they can tolerate and how much volatility they can tolerate. And again, for us as investors, public investors, we have our clients to manage money off. So we don't want to provide too much volatility in the NAV as well for them. Because the experience of investing, if it is too volatile, then people generally skew their expectations a lot, and on both sides. So if you suddenly have a short period of time where returns are very good, people might want to extrapolate those returns in the future as well. Whereas if the returns are lower in the short period of time, people might say, oh, now this is going to go down and it's never going to turn around. So the dejection and the high expectation both should be managed, and that can be only done in a diversified manner. So in our case, we think this is a way where we build a portfolio of 25, 30 stocks, which we like. And within that, you will have some sectoral concentration. Some stocks will be a little bit higher in weightage because we understand them a little better and we think they can do much better in the future. And some stocks will be much smaller because of the allocation choices we have made. But these are purely our subjective choices and they can differ. So I think understanding the subjectivity of the portfolio allocation is the biggest lesson over here, and not to copy anybody's style just because you admire them, admire their process of investing. That is actually the key lesson I think any investor should take.
All right. With that, it's time for us to wrap up this chat. Thank you, Raunak, for taking the time for this interaction. It was lovely talking to you.
Thank you, Chirag and Rushira, for having me. Thank you so much.
Thanks.